Hello, everybody. I'm Rhoda Shermer, and I'd like to welcome you to the Network for Responsible Public Policy's July program. We've got hot button topic tonight covering the economy and inflation. And luckily, we've got at least two of our three experts here to help us understand this complex and controversial subject. And we're waiting for Nicole Gelinas, and hopefully she'll show up soon. I want to thank you guys for participating. It's really going to be a stimulating evening. But before I turn the program over to you, Peter, I want everyone to know that you are the opinion columnist for economics at the New York Times, and you will serve as the facilitator and introduce the speakers and take over in a bit. Before I turn the program over to you, I do want to talk a little bit about the questions, because we do think the questions are very important. We want all of you to ask a lot of questions, keep submitting them. That way we get more information out into the public arena and hopefully satisfy your concerns. So all through the program, as any questions occur to you, please just click the Q&A button at the bottom of the screen, and Peter will be handling the questions. So thank you all for joining us, and I look forward to hearing the program. So Peter, I'm turning it over to you. Peter.
Sorry, I forgot to take myself off mute. I will start over.
And I'm going to go dark.
Our two speakers, Nicole Gelinas, Senior Fellow at the Manhattan Institute, contributing editor of City Journal, columnist of the New York Post, who writes on urban economics and finance, as a CFA, and she is the author of After the Fall, Saving Capitalism from Wall Street and Washington. And further bio details are in the invitation to this event. Second panelist, Bill Cohen, former senior Wall Street M&A investment banker, Lazard Prayer, Merrill Lynch and JP Morgan Chase, best-selling author of 3 nonfiction narratives about Wall Street. I won't give all the titles here, but you can find them in the bio. Former longtime special correspondent, Vanity Fair. Founding partner of Puck, which is a daily digital news and opinion publication. And I'm getting Bill's missives on Puck. I recommend them to all of you. So with that, I'm going to dive right in. I do think we have a great subject here today because I write about this all the time myself. It's kind of mystifying what's going on. Rhoda teed it up a little bit, but it's actually even more bizarre than what she said in her intro, wrote in her intro, because we have 9.1% inflation the latest month, which is the highest in more than 40 years. At the same time, the nation's gross domestic product fell in the first quarter, and a lot of people think it's going to fall in the second quarter. These things don't usually go together. Very high inflation coupled with falling output. So I think the first thing I'm going to do is just dive right into what's confusing everybody. And I guess I'll start with Nicole. Nicole, why do you think, what's going on here? How do you explain this bizarre confluence of events?
Yes, good evening, Peter. And I want to start by thanking Rhoda, of course, for hosting us at this unfortunately quite necessary event this evening. What is causing this confluence of events of high inflation and low and potentially, as you noted, negative growth? I'll just leave you with 3 thoughts, and we can hopefully expand or discuss the thoughts as the program goes through. First, this is not just a US phenomenon. So I know that we are fortunate to have people watching and listening who are Republicans, who are Democrats, who are independent. There's sometimes a tendency to say, this is all President Biden's fault. President Biden has brought us very bad policies that have caused this high inflation after 40 years of reasonably low inflation. Well, as you noted, the US inflation rate of 9.1%, we got news today from Britain that the British inflation rates was 9.4% last month. And we see this throughout the Western world, in inflation going from very low historically to ratcheting up to flirting with double digits over the past few months. So one, not just in the US. Biden has some responsibility for it, which we can talk about later, but the inflation that we're seeing is not entirely due to his policies, or even mostly due to his policies. Two, much of this, but not all of it, is due to what's going on globally in terms of Ukraine, the Russian war against Ukraine, pushing up energy prices, obviously, with the risk that Russia cuts off gas supplies to Europe, as well as the oil sanctions against Russia. And food prices. Ukraine is a large producer of grains and basic foodstuffs to much of the developing world. Much uncertainty over whether Ukraine will be able to export its grain harvest this year, which means farmers aren't planting for next year. So we see the price of food going up around the world. These two things together, price of energy going up and the price of food going up, obviously have a great deal to do with inflation. But the third thing I'll say, and perhaps the most controversial, is that although we could not have predicted easily the war against Ukraine and these two immediate supply shocks in food and energy, this has been a long time coming, in that for the past 20 years, even longer than that, actually, the US government and much of the Western world's governments, whenever they are confronted with the possibility of a recession, what do central banks do? The Fed, the ECB, other central banks across the Western world, Bank of England, Bank of Japan, immediately cut interest rates. And why do they do that? Because they want businesses to keep borrowing and lending. They want consumers to keep borrowing and lending. Borrowing is obviously much easier to do when interest rates are low. So we've had a bipartisan, nonpartisan really, regime across administrations of, when there is an economic threat, we cut interest rates. What does that mean? It means that there is much, much more money floating around in the financial system than there would be if Western governments had kept a more neutral monetary policy. So, for example, during the COVID shutdowns, households saved trillions of dollars in their checking and savings accounts because with low interest rates, the government encouraging people to save, or rather to borrow money from financial institutions, there was nothing to spend that money on. So people built up these saving stockpiles. What are they doing now when prices are rising by 9%? They are drawing down on these savings. And for a while, at least, they are able to pay these higher prices. So loose monetary policy has enabled this high inflation that we're seeing. And I'll stop there and look forward to what William has to say. You're still on mute.
Sorry, I just wanted to throw it over to Bill. What's your thought on this?
I mean, Nicole is, of course, absolutely right. You know, I might weight the factors a little differently. I personally think, 13 years of zero interest rate policy, 13 years of quantitative easing, 13 years of the Federal Reserve expanding its balance sheet, from 900 billion of assets to 9 trillion of assets. 13 years of the Fed encouraging risk taking, encouraging borrowing, as Nicole said. I mean, the borrowing, corporate borrowing, personal borrowing is at extraordinarily high levels. The risk taking that we have seen, whether it's in the price of that, the average price being paid by buyout firms when they buy companies, the price of ridiculous price and the bubble surrounding cryptocurrencies, NFTs, Tesla, you name it. I think the Fed has been really encouraging risk taking for 13 years. And of course, some would argue between being the lender of last resort and making sure unemployment is low, and that money is available to people 24 hours a day, 7 days a week when they want it at prices that look attractive, that that's part of their job. But the bigger part of their job, I think, is, as William McChesney Martin, the longtime Fed chairman, said, it's their job to pull the punch bowl away when the party's getting started. My view has been that the Fed has been pouring tequila into the punch bowl this entire time with nothing to water it down. So to me, this was completely, expected, and all of the things that people who believe passionately in Bitcoin and cryptocurrencies talk about is that, and which proved to be fallacious as we found out, but that printing of money and central bank profligacy would come back to bite us, and so it has. And so I give Larry Summers a lot of credit for seeing this early and often and talking about it. And the way he talks about it is, he talks about the Fed missing the boat here. And I think he's absolutely right. And that's why I think a big part of, obviously the war in Ukraine, the pandemic with supply chain issues has exacerbated this inflationary spiral. But if it hadn't been for the Fed and its zero interest rate policy and its quantitative easing, I think we'd be in a much better off place than we are now.
Okay, so I'll just jump in with my own thought on this, which is that obviously the Fed pursued extremely loose monetary policy, starting with the global financial crisis, 07-09, and actually starting 08 after the recession had already begun, and continued that all through the 2010s at a time when it seemed to have no effect. Inflation remained not only low, but too low, below the Fed's target. So people began to think, well, it's hard to argue that the Fed has pushed rates too low, that is being too stimulative when the economy is sort of dragging along and there's below target inflation. So, I just want to hear Bill, maybe Bill first, and then Nicole. What is your thought about that? And if it's easy to make the case now that the Fed was overly stimulative, but what about the previous many years when it was also stimulative and yet the effects are quite different?
Well, thank you, Peter, because I've been writing and over the years in the last since 2008 in your newspaper, regular op-ed columns about how I believe the Fed is, going overboard here. And if you talk to somebody like Peter Schiff that I have, he makes very, I think compelling, cogent arguments for why, the way they calculate the consumer price index is not what it once was, and they're missing big components of that. So one part of the problem is, you say the inflation rate was low, and maybe they've just been measuring it improperly. I mean, and if you sort of take it away from sort of, the technical analysis of the way these things are measured, I mean, if you just anecdotally looked at what's been going on in the financial markets for the last 10 years. I mean, if you look at, my favorite measure of this is the St. Louis Fed, index of the average yield on junk bonds. I mean, last fall, the average yield on a junk bond was under 4%. Now, I'm old enough to know back in the day that, when Mike Milken was in charge of the high yield market and creating the high yield market and financing all sorts of companies with less than stellar credit, that the average yield on a junk bond was 10, 11, or 12%. And that's before the warrants that Milken usually got that were supposed to go with that to investors that he ended up pocketing, which is a whole nother topic. But to have junk bonds yielding below 4%, which means that huge swaths of the investing public or institutional investors are completely mispricing risk. So there were real estate was out of control, the high yield market was out of control, the leveraged loan market was out of control, corporate debt market was out of control. I mean, there were so many indicators, cryptocurrencies completely out of control, Tesla completely out of control, you name it, meme stocks. There were so many anecdotal indicators of a economy way, way overheated, and then the Fed to sit back and say, oh, inflation's not as high as we expected, and oh, unemployment is, where we'd like it to be, and we're not going to do anything, is, to me, completely missing what was going on in the real world.
Okay, I just want to remind our listeners, our viewers, to put questions into the Q&A. I'm going to go to Nicole, and then I have a couple thoughts I want to say myself. Nicole, what are you thinking about this?
I wouldn't disagree with anything that Bill said. I would only add that much of the inflation up until late 2021, it showed up in the asset markets rather than the markets for goods and services. So what does that mean? When you look at, for example, companies like Uber and Lyft, where if some of our viewers are from the New York City metropolitan area, areas around Los Angeles and San Francisco, 5 years ago, you could e-hail a black car, take a trip, pay a very, very low rate for that e-hail trip and go on your way. Today, if you try to hail an Uber or Lyft, it's going to cost you $40 or $50 to take a short trip within New York City or the region. Similar situation in California and other metro regions. So why has the price changed so much? 5 years ago, these companies, even though they've never made any kind of profit, they've never shown that they can be profitable, they were able to attract tens of billions of dollars in venture capital, investment bank, and later public markets investments. Why were they able to do that? Because the Fed had created so much money in trying to keep interest rates low that this money just had nowhere to go. So you had the absurd situation where you had billions of dollars in investment capital going to an industry that for hundreds of years had been profitable, from when people hailed horses and buggies and were taken on a trip and paid a fare and were able to support through those fares the livelihood of a driver and the horse going through the taxi industries of New York City, San Francisco, Los Angeles, and up until more sophisticated telephone hails, black car companies. This industry was always profitable. You have Uber and Lyft come along, make it entirely unprofitable because they wanted to build up a monopoly in this business, but yet able to attract these investment dollars because there was just so much free money floating around. That free money has dried up, but until it dried up, you saw this not only in Uber and Lyft in below market prices for e-hail cars, but you saw it in the high-end housing market. I mean, the super luxury market in New York City, largely for people not looking for a place to live with their families, but just investment properties, properties that are empty 10, 11 months out of the year, just a place to sort of stash some money and hope that the value of that money is not destroyed by market downturns. So much of this inflation, until we started to see these pressures come out of COVID, come out of the Ukraine war, come out of higher energy and food prices, this free, cheap, loose money showed up in the asset markets before it showed up in these markets for basic goods and services, and was not a very healthy situation. We had a lot of misallocation of capital. Instead of putting these investment dollars into productive industries, automation to make workers more productive, we put this toward subsidized consumer services, in attempting to build monopolies that never quite worked out. And now we see a pullback of that without much gain from it.
Great. I just want to help out our viewers by just backing up and providing a very simple explanation of what's underlying some of this conversation, which is, what is inflation? And one economist definition is that it's changes in the consumer price index. There's also changes in the producer price index, but let's focus on the consumer price index. So what they do is they create a market basket of what typical Americans buy, and then they figure out what percentage of the spending is for housing, shelter, how much for food, and it's broken down much more than that. It's broken down into eggs and lettuce and so on. And then they just send out shoppers, or they do it electronically and figure out, well, what's been the change in the price of each of these items? And they wrap that up into what's the change in the consumer price index. And it's fairly cut and dried approach. As tastes change, they will make revisions in the market basket. People buy more of this, less of that. And, sometimes they get a little more sophisticated. If a cell phone has a lot more power than an old cell phone, it's the same price, well, they will call that deflation because you're getting a better product at a same price is equivalent to a price cut. But what Bill was talking about here was not so much the consumer price index, although he may have issues with how that's calculated. It's focusing more on the asset prices. That'd be like prices of stocks, bonds, real estate, maybe various commodities. And so the challenge for central bankers or other policymakers is, what do you do when the situation is that consumer prices are well behaved, or actually too low, growing too slowly? At the same time, asset prices are going to the moon. And you recognize that you're partly responsible for that your easy money is pumping up asset prices. What do? Well, one response is to raise interest rates and try to bring asset prices down to sort of deflate that asset price bubble. But if you do so, you run the risk of harming the quote-unquote real economy, making interest rates too high for consumers and businesses, causing a recession or an economic slowdown. So it's a balancing act, and different Federal Reserve boards, chairs have looked at that decision, that trade-off differently. So I'm not saying who's right and who's wrong, but I wanted to help viewers by kind of giving them the subtext to some of the conversation here. And I just want to add one thing too. Nicole made a great point about how sometimes high asset prices can feed into the consumer price index, and the way she described it is with, say, Uber and Lyft. If you pour a lot of money into those companies, those ride-sharing companies, they'll turn around and have artificially low prices for their services, which do show up in a low consumer price index. So the asset price inflation translates into consumer price deflation. So with that, I'm going to go back to Bill since I think it's his turn. But Bill, talk about that trade-off between how to cope with asset prices versus consumer prices.
Well, Peter, I'm not an economist. I'm like a practitioner, right? I'm an observer. I was a banker for 17 years and then writing about Wall Street for 17, 18 years. So that's 35 years of observation. And, I started on Wall Street in September of 87, and a month later, the market crashed 22.6% in one day, the single largest decline.
But not your fault.
Not my fault, but I saw my colleagues standing around a Quotron. People don't even know what a Quotron is anymore, but standing around the Quotron in tears. And so, because they saw their wealth dissolving in a day, or what they thought was their wealth, and they didn't know whether it would return. I mean, I've lived through so many, financial crises. I don't buy, I guess, the argument that, the financial economy is so closely tied now to the, industrial economy, the real economy that you were talking about. I don't see any difference. And in my lifetime, I don't think there has been any difference. Every time the financial markets get into trouble, the Main Street gets in. Every time Wall Street gets into trouble, Main Street gets into trouble. And they're so closely linked. If you can't get access to capital, if the credit markets freeze up, if people completely lose confidence in valuations and in markets, and which is what's happening now, where you have a complete disconnect between sellers who think it's still September of 2021 and buyers who know that it's July of 2022, then you get a lot of gummed up capital markets, financial markets that aren't working well. And when that happens, it trickles into Main Street in short order. So, I think that the Fed can get these blinders on and get all caught up in their economic models and their PhDs and ignore what's going on in the financial markets, which are really the thing that is, wholly the carburetor on our whole economy.
What are your thoughts, Nicole?
Yeah, I would agree with all of that. And I think that one example of how the financial world is inseparable from the real economic world is in the housing market, where you see we had the housing crisis of 2007, 2008. And the Fed's response to that was to cut interest rates to zero, as Bill mentioned. Why did the Fed do that? Because it wanted people to be able to continue to borrow as cheaply as possible, to purchase new houses, to refinance their existing mortgages, and try to prop up the housing market in any way possible. Other reasons as well. I mean, the Fed wanted people to borrow for business expansion, borrow on their credit cards for consumer consumption expansion, but mainly prop up the housing market at all costs through historically low interest rates. So what do we see today? almost a decade and a half later, as inflation tops 9%, as you said at the beginning, the Fed is very quickly increasing interest rates. What does that mean? It means that mortgage rates also go up. And so there is a real risk, which in the long term may not be a bad thing, but in the short term is very difficult for the American economy to digest, in that if I'm looking to buy a house, I'm a first-time home buyer, I make X amount of money per month. I can spend X% of that money per month on a mortgage. So if interest rates go higher, the interest rate, the portion of my mortgage that I'm spending on interest goes up. That means the portion of the mortgage that I can spend on the actual value of the house goes down. So your average first-time home buyer has less money in purchasing power to use to buy a new house. What does that mean? It means the price of houses goes down. And so if I have a house, even if I don't want to sell it, I can look on Zillow every week and see the value of my house is falling because a hypothetical person who might want to buy my house has less borrowing capacity to buy that house. If the value of my house is falling, I feel poorer because I know I can't take equity out of my house. I know I can't sell and buy a larger house or a house in a nicer community. So this has a real psychological effect as well as the economic and financial effect that house price declines are generally not good for consumer spending, consumer sentiments, and the economy. Now, it used to be the other way around. If the economy was doing well, people had money to buy a house. We've kind of made this backwards in terms of government policy through these last financial crisis, in that we want the housing market to do well so that the economy does well, but it's not clear for how long we can sort of sustain the cart driving the horse, if you will.
Okay. I'm going to read off several questions at once to try to get a lot of more ideas into the mix, and try to keep in mind what I'm asking you so that you can maybe pick and choose which ones you feel you want to try to give an answer to. Somebody asked about the pandemic, whether climate crises are making resources more expensive and scarce. That was Sandy Silverberg. We have an anonymous attendee saying, how long do you predict this period of inflation will last? What will recovery look like? Will we return to the period of record stock prices like last fall? Sandy again is saying, this sounds like greed, where the foundations laid back in the Reagan era. Lee Chinnett says, I guess there's a lot of blame to go around, maybe especially towards the Fed. What do you think has to happen now? If I understand correctly, the primary way to reduce inflation is tight money that at least at some level pushes the economy towards recession, reducing demand. Is that what has to happen now? Or is this case with the whole Ukraine war, COVID pandemic different from previous times of high inflation? There's some more questions here, but let's just maybe group those and we can come back with more questions later. Either one of you want to tackle any one of those questions?
Well, I mean, quickly, I would just say I think it's the correction that we're enjoying now is painful, and it's also shameful that we have to endure it because of these policies of our central bank. And again, not just unfortunately, our central bank is a leader, and so central banks around the world have also done the same thing, and now they're reversing course. But if the Bernanke Yellen axis, Jay Powell axis, had been quicker to turn off the easy money spigot, as say somebody like Larry Summers wanted them to do, I think we would not be, enduring this now. And so I think the Fed gets, as I said, a lot of blame. But I also think, now I think they're doing the right thing, maybe not even fast enough. I think it's healthy. These markets need to, correct. We need to take a lot of the exuberance out of these markets, and that's what's happening, and that's the healthiest thing that can happen. So it's painful, but it's also fabulous. So and needs to happen. I mean, so for the last 13 years, in my mind, the bond market has been uninvestable. How can you possibly invest in a high yield bond when it's yielding below 4%? That is a huge miscarriage of responsibility, of your fiduciary responsibility, and you couldn't possibly do that. Now, however, the average yield on a junk bond is looking like 8.5%, 9%, and that's like in 6 months. It's just been amazing what's happened, and that's across the bond market. All of a sudden, the bond market, which most people don't understand, is looking incredibly tasty, and probably got more to come in terms of yields going up, and it's going to be investable again. And that's the best news we could possibly have for the overall economy. So my view is, painful, yes, but long overdue, and let's just get where it needs to be. Investors get rewarded for the risks they're taking. When that happens, capital flows all over the place. And when interest rates are being manipulated by the big kahuna, which has been happening for 13 years, then you get a complete misallocation of capital, as we were talking about, as Nicole was absolutely right about. And so, this is long overdue, much needed. Let's get on with it. Let's get interest rates back to where they should be, so that risk is allocated properly and people get rewarded properly for the risks they're taking. And when that happens, the spigots will open.
Nicole?
Right. I, again, agree with Bill on all of those points. And I believe the questioner asked about how much of this is due to the pandemic. And I think one change that stems from the pandemic that I think is going to be a long-lasting change is the increase in wages at the lower end of the income scale. So we know that the federal government sets the minimum wage at $7.25 an hour. It's been that way for more than a decade. But the pandemic revealed to all of us how important all of the minimum wage workers and people who make slightly above the minimum wage are, their criticality in keeping the economy going, whether it's staffing a pharmacy, staffing supermarket, home health aides, aides in hospitals, doctor's office, and so forth. In less essential but still important work done in restaurants, retail stores, across the minimum wage or close to minimum wage spectrum, where we saw during the first year of the pandemic, many of these jobs in retail and restaurants, certainly not in hospitals and supermarkets, these were the first people to be laid off very quickly. Federal government stepped in, provided extraordinary unemployment insurance that basically brought the base wage, if you were to stay home, understandably, and being nervous about catching COVID in the first months and so forth, and so opt to collect unemployment benefits instead, you could earn up to $60,000 a year in extraordinary unemployment benefits. So what did that do? It made people very reluctant to go back to the workforce for a minimum wage job. And of course, it's not just economic. I mean, many people who were not the primary breadwinner in their home said, maybe I'd rather spend more time with my kids. Maybe I'd rather go back to school. Maybe I'd prefer not to work in the restaurant industry and choose a different career path. For various reasons, people have been very reluctant to jump back into the workforce. So now, even as these extraordinary federal unemployment benefits have expired, still very, very difficult for low-wage employers to find workers. So what does that mean? Supply and demand. The minimum wage is up in the market, if not in the law, in that very few people would go to work today for $7.25 an hour. You see the wages of restaurant workers, retail workers, hotel workers, airport workers, hospital workers. All of these wages have gone up by double digits over the past 2 years. People making $18, $20 an hour, even $25 an hour, where they used to be making minimum wage. This contributes to inflation because, of course, if you go to a restaurant, go to a hotel, purchase a meal, purchase another good or service, you are mostly paying for the labor. So if the price of the labor goes up, obviously the price of the good or service goes up. I think that is something that is not going to disappear. If you've gotten used to working for $18, $20, $25 an hour, you are not going to go back to work for $7.25 an hour. You'll just leave the workforce and wait for a better opportunity to come along. So in that sense, raising the floor on minimum wage jobs and making it far more the norm than not that job pays $20 an hour rather than $7.25. This is a big part of inflation and is something that will be with us indefinitely.
Okay, I just want to go back with another sort of principles point, because I have something, sometimes we zoom into the arguments of the day and we don't help people enough with sort of underlying concepts. So supply and demand. The Federal Reserve can cope with demand, not supply. Let me explain what I mean by that. When the Federal Reserve, the economy consists of people supplying goods and services and other people demanding them, buying them. And when you have high inflation, it can be caused by a dislocation on either side of that. And in some cases, as in this case, both. So we had strong demand because of the points Bill and Nicole made. The government pumped in huge amounts of money into consumers' pockets to try to protect them from the consequences of COVID, given that extra spending power. That raised demand. At the same time, supply became constrained, partly because of COVID interrupting production. And then you had the war in Ukraine driving up oil prices. So in constricting the supply of oil and gas, natural gas and so on. So you had a double whammy of rising demand and falling supply. So how do you correct that? The Federal Reserve can't really do too much about the supply side of the economy. Nothing the Federal Reserve can do will cause Vladimir Putin to open the taps on natural gas to Poland and Germany and so on, or produce more wheat in Ukraine. Federal Reserve mainly affects the demand side. What it does is by raising interest rates, it discourages people from borrowing. That would be both people, being both businesses and consumers. And there's a justifiable concern that if it uses its one lever to excess, that is, tries too hard to squelch down demand as a way of curing inflation, that will cause a recession. And then the debate becomes, well, is that justified or not? Is it necessary or not? And I've written in my newsletter in the New York Times opinion section, which I hope you all sign up for, along with signing up for Bill's Puck and Nicole's newsletter, the Manhattan Institute, that that actually would be a mistake to go too far, too fast on raising interest rates. That I would argue that inflation is actually coming down naturally. And one of the people that I follow closely, I recommend to you, is David Rosenberg, who has his own operation Rosenberg Research in Toronto. He was at Merrill Lynch for years, and he's been making the case that if you look at commodity prices, they're coming down. You might have noticed gasoline prices even are coming down noticeably. We're down around 4.25 versus over $5 a gallon for regular now in New Jersey. And you see it with copper, which is heavily used in industrial production. So it's a sign of how much demand there is for the manufacturing side of the economy. Unemployment remains super low and job growth remains super strong. At the same time, you're seeing layoffs here and there, and unemployment is not a leading indicator of the economy. So if you point to strong job growth and low unemployment as evidence the economy is strong, well, you're sort of looking in the rearview mirror. Evidence that employers have been hiring aggressively, but it's not evidence that they will continue to do so. And things can tip rather abruptly from strong growth to suddenly trouble in the labor market. So you're thinking about what the Federal Reserve should do. It should raise interest rates, but how quickly it should do so, because the U.S. economy is like a car with loose steering. You turn the wheel to the left, and it takes a while before the car starts moving left. Then you realize you oversteered, so then you turn the car back to the right, and suddenly you're veering back and forth across the road until you crash. That's my metaphor. So against Bill and Nicole, I guess I'm more the dove when it comes to thinking about how the economy should be managed. Probably I'm putting a higher weight on the scariness of a recession versus inflation, which I think is a problem for sure, but maybe is already coming under control to some degree. Either you want to jump in on that, or because after you respond, I'm going to go to more questions from the audience.
Yeah, I'm happy to start and tackle some of those issues. I think you're absolutely right to bring up the fact that gas prices have been falling over the past couple of months. High prices destroy demand. So people see $5 gas at the pump and they say, maybe I don't have to take that 20-minute trip to a restaurant. Maybe I can find a place to eat closer to home. Maybe I can skip a few of these trips by planning my shopping better. And so you see at least a marginal decline in the demand for gasoline, which accordingly pushes down the price. And so I think the Fed, in its aggressive interest rate hike in June, is trying to send a message to financial markets. Hey, we understand that this is going on, that inflation is a concern. The message has been received. So yes, I do think the Fed has to be careful that they don't want to raise rates so aggressively that they cause a recession that's very difficult to recover from, except for then by cutting rates again to 0%, and then we're right back where we started.
Bill?
I mean, obviously, Peter, if inflation is coming down and the markets are correcting and risk is being priced correctly, and people are coming back to their senses again, and some of the air is being taken out of the markets, and they don't have to raise interest rates, in a Volcker-like fashion, then, that's great, because, we don't need to have a recession just to have a recession, to make people suffer. We need to have an economy where risk is being priced correctly, where the price of money is driven by supply and demand, not by a major big-footing participant in the market that is going to buy up every bond that's out there that nobody wants to raise bond prices and lower yields, which is what's happened for 13 years. I mean, if Jay Powell is able to spread enough foam on the runway to land this plane safely, as they like to say, then hallelujah. Then, you know, raise interest rates one more time and call it a day. But, you know, as Nicole was saying, you know, if you've been making $25 an hour, you're probably not going back to 7.25. Wages are going up. I mean, look, I think it's fabulous that home prices are falling. I think it's fabulous that gas prices are falling. You know, I was writing the other day about, which I don't understand, about, you know, obviously, you know, investment banking volumes on Wall Street are about half what they were in the first 6 months of this year compared to last year, and yet for some reason they're paying junior bankers. They've raised pay raises 3 times and so far this year. So, you know, that kind of stuff needs to stop. Bankers are already way overpaid for what they do. So, I mean, you know, if the markets just sort of calm down and get rational again, and prices start to get rational again, and supply lines get fixed, and then there's no reason to use monetary policy to make people crazy.
Okay, good. So I have some more questions from the audience, and I'm going to group them again. So just pick out the ones that you think you want to answer. David Ferris asked about the relevance of wage and price controls. Michael James says, what is the role of crypto for the future? Why is it so closely tied to traditional stocks as the economy slows? Many thought it would be an offset or healthy on its own, but it seems to be plummeting at the same or rate as stocks, traditional stocks. Here's an anonymous attendee saying, doesn't it seem majorly flawed that markets are ruled by decisions and actions of wealthy corporations and banks, that these negatively affect the whole country? Majority players of real estate markets are the wealthy who can afford to access them, for example, okay? Sandy Silverberg asked about climate change. Chris Boss, the flawed quantitative easing point, we didn't really define quantitative easing, but I'll just jump in. That's buying bonds as a way to bring down long-term interest rates. What's interesting, but given that has been practiced for more than a decade, that can't be the main driver to the current inflation increase. That's a point I kind of made earlier. Other than energy and food price increases, which are ruled by geopolitics, COVID, supply chain issues, China's zero COVID policy. So there are a lot of things going on. Feel free to jump in on any part of that. Oh, somebody wants us to put the URLs of our newsletters and so on in the chat. So I wonder if Stephen, you could do that, because I'm a little busy right now. Then we have Lee Chinitz again asking about NAIRU. NAIRU is NAIRU. It's a non-accelerating inflation rate of unemployment, sort of a natural rate of unemployment. The idea is that if you try to push unemployment too low, it just won't go any lower. All you'll do is get more inflation. So Lee's question is that an outdated framework for thinking about the economy, or is there something to it? Do we have to drive unemployment higher to reduce inflation? So maybe I'll start with Bill. Anything in there pique your interest?
Well, I am interested in cryptocurrency, in the whole phenomenon. It's I've been working on a documentary film about cryptocurrency, so I've been interviewing a lot of cryptocurrency founders and pioneers and trying to understand how this all came about. And you know, Bitcoin was really created. You know, the Bitcoin white paper came out in, I think, October 2008, literally in the midst of the financial crisis. And I don't think it's a coincidence. I think seeing our institutions devolve in front of our eyes, spurred on this whole movement about decentralized finance. But I'm just kind of blown away after spending, close to a year talking to all these different pioneers and founders of these companies and movements and thoughts, and that it wasn't supposed to work this way. Like, it was literally supposed to work the opposite of the way it's worked. I mean, Bitcoin and Ethereum, the two biggest cryptocurrencies, have fallen more than the stock market as a whole, which proves to me what I always thought, which is that they're just ways to speculate, that there was no utility to Bitcoin or Ethereum, or at least not yet. And it was all about speculating and finding the greater fool. And I think that's what we have uncovered here, as opposed to, a salvation for central bank excess, which I think, frankly, a lot of people were looking for. People were looking for a salvation for central bank excess, which we got, as I've repeated 100 times now in the last 13 years. And to find out that, Bitcoin is not the salvation to central bank excess is a bit of a slap in the face. And I find that quite revelatory. And I was sort of hoping it would be different, but it didn't turn out that way, not yet anyway.
Bill,
Whereas go ahead.
Do you think there is some other safe haven against, as you call it, central bank excess? Not gold, seemingly, or maybe it is gold.
Yeah, well, I mean, people do say still, like, the Peter Schiffs of the world still talk about gold. I don't, what I think, of course, when everything is sort of, the air is coming out of all the balloons at once, which is sort of what's happening. There aren't a lot of safe havens, but I think there are safe havens in well-run companies, the equities of well-run companies without too much debt, that pay a decently high dividend, and that know that they're all about shareholder value and profitability, and basically sort of have a moat around what they do. I think that's the safe haven, and that are not trading at nosebleed levels like Netflix, or meme stocks, which just are absurd. The risks that people were willing to take, mainly probably because the money that they were using was free, or they thought it was free, or they thought they had no cost to it, or safe havens. Boy, if I knew what the safe havens were, Peter, I probably wouldn't be on a panel like this at 8:30 at night.
Sure you would. All right, Nicole.
I'd
what
be
about,
on my yacht, my mega yacht in the
Mediterranean. Yeah, but you'd be doing a Zoom from your yacht.
That's true.
All right. Okay. So Nicole, what piqued your interest out of those questions?
Yeah, the Wi-Fi price from the yacht might be expensive. If it's like a cruise ship, you're paying like $5 a minute for the wireless connection. So I don't know, but I guess I'd return to the question about whether quantitative easing could have anything to do with current inflation, because as the questioner rightly noted, the Fed started quantitative easing in the fall of 2008. It's now 2022, so if quantitative easing was the problem, we would have seen it before now. I would gently push back and say that I think the inflation that we see today does have something to do with quantitative easing, because when there was a surplus of workers around the world to provide goods and services at a cheap price. The goods and services, whether it's purchasing a consumer product imported from China, going to get a haircut, going to a restaurant and being served your food, going to a retail store and purchasing clothing or shoes or what have you. The global market of cheap labor was able to provide all of the supply that the American consumer demanded. So we never had a massive increase in the price of clothes or shoes or manicures or haircuts because people were demanding these things at high rates. There was always a greater supply of labor, either domestically or globally through imports, to supply this demand. That lasted until 2020, when the pandemic really changed the labor market, as we talked about already, not just in the US, but around the world. And we see a continuation of lockdowns in China, significantly constraining the global labor market. But beyond that, so if you wanted to buy a consumer product, it was there for you. Your demand for that product did not push the price up. So what happened to all of that extra money that the Fed created through quantitative easing, which was just a way of the Fed printing up money electronically? You know, if you could sit at your computer and say, I don't like my bank balance. I have, you know, maybe $5,000 in the bank. I'd rather have $5 million. So I'll just add a few zeros and I've got $5 million in the bank. That is basically what the Federal Reserve did with the nation's supply of money, is add those zeros, use that money to go out and buy bonds and thus further reduce interest rates. You know, a little bit complicated to grasp, but the end result is a larger supply of money in the US economy, in the global economy. So when people had all of the consumer goods that they needed, what did they do with that money? They put it in the stock market, they put it in the bond market, they put it in the housing market, they put it into, if you were a wealthy investor, venture capital, into Uber and Lyft. So that pushed up the value of all of these markets until 2020, 2021. And it also meant middle class, affluent middle class worker had excess savings, and those savings just sat in checking account, savings account, money market account. People didn't know quite what to do with this money, so they just left it in these accounts. So what happens when the price of goods and services starts rising? So I go to the supermarket, instead of a dozen eggs costing $2, it costs $3.50. The price of milk goes from $3 to $4.50. You know, mayonnaise, for example, I think I just paid $9 for a jar of mayonnaise at the Whole Foods. I think it used to be closer to $6. So people are taking that money out of their savings accounts, out of the stock market, out of the bond market, and using that money to continue their purchases of goods and services. If, for example, a restaurant meal, if I'm an affluent consumer, used to cost maybe $120. It costs $200 now. For a while, at least, people will draw down on their savings and pay those higher prices. And so that's what we're seeing right now, is people taking down those savings that they accrued during quantitative easing and keeping up with inflation. Now, that can't go on forever, of course. At some point, even if you're fortunate enough to have saved a good deal of money during the pandemic and before, you will say, I've still got to retire. I could lose my job. I could lose some income. I have to buckle down. I can't take that trip. I can't go out to eat, you know, 5 times a month or whatever. I've got to save some of this money again. So, you know, just as we talked about before, higher prices destroy demand, but they've been slow to do so because of all of this built up money in the economy.
Yeah. I agree with that, Nicole. I think one of these solutions that I sort of flicked at earlier when I was talking about supply and demand is to focus more on the supply side of the problem. And I think the Biden administration has tried to do this, but I think there's more to be done. Problem with that is it's more of a long-term solution. The idea would be, okay, if the problem is not enough energy, create more energy, whether that's, we would hope it'd be green energy, solar and wind. The problem is, lack of semiconductors. Well, maybe we need more chip fabs in the United States. If the problem is labor, and it is, then we need more workers. And we need more workers with skills. So we should be educating people, and some of that would be community college, apprenticeships, and so on. Or it could be something as simple as childcare that allows more women to go to work instead of having to stay home taking care of their kids. The beauty of a supply side solution is that it brings down prices. At the same time, it puts more money into people's wallets because people get paid for the extra production they're doing, versus a demand side solution, which is sort of restrictive. It's like saying, let's throttle the engine back. It's almost like admitting defeat to a degree. I don't want to, and I don't want to make it sound easy because it's not. But supply side solution, that used to be a term that was associated with the Reagan right, because they talked about how high taxes restrict the supply side by discouraging companies from investing. But some liberals have adopted the supply side as well. They're just putting a different spin on it and saying, government can help by creating incentives for, again, more production, greater labor supply, and so on. So if we're talking about our big theme here is what to do about the problems in the U.S. economy, to me, high up on the list, not just for the short term, but for the long term, should be expanding supply side. Any thoughts on that from the panels? Oh, and just I want to say, we're still open for questions from the audience, and it can be anything. It doesn't have to be a econ type of question. If you want to do more of a personal, like what's in it for me, that's fine too. We want to make sure that we are serving the needs of the audience. But for now, just Bill and Nicole, any thoughts? You want to talk about either what I said or what other people have been saying? Well, there are a couple of things we didn't really answer yet among the questions that already been asked. So like, let me see here. One of the questions that came in very early, which I didn't even ask, but I'll ask it now. How long do you predict this period of inflation will last? Any guesses on that? My own guess is that inflation is not deeply embedded in people's expectations yet. What tends to cause inflation to be persistent is that it becomes embedded in expectations, and people demand higher wages, they charge higher prices because they expect prices to go higher. And yet surveys of the consumers and businesses, as well as market action, when you look at the, they call it the five-year inflation forward curve, show that expected inflation in the coming years is actually not that far above normal. It's more maybe 2 to 3%, which is very close to the Fed's 2% target. But what do you guys think about the outlook for inflation?
Yeah, I mean, if I knew how long it would last, I would be inviting Bill on my own yacht at 8:30 at night. But I will say there's a important inflection point that I don't think has come to pass yet, and how we deal with that inflection point will have a good deal to do with how long this lasts, which is when unionized labor and other organized labor starts to demand raises that keep up with inflation. So for example, New York City government workforce, we've got 130,000 teachers, we've got 40,000 transit workers. We've got 40,000 police officers. We've got a few thousand firefighters, sanitation workers, correction workers, and so forth. All of their contracts are expiring this year. So for the first time since the late 1970s, early 1980s, you'll have union leaders, and not unreasonably from their perspective, saying the price of goods and services for our members went up by 9.1% this year. They're projected to go up by another, let's say, 8% next year. So we're going to need a 20% raise over the next 2 years. So that's when we start to see a real wage price spiral, where workers with power, whether through a union or because they're essential to the workforce, well above the minimum wage points, are saying we need our wages to keep up with inflation. What does that mean? It means then those higher wages then go to support higher inflation in goods and services, because people getting a 20% wage increase have more money to support the higher price of goods and services. So it's a very difficult issue, because it's very hard to say to people, okay, inflation is high, but we're not going to give you a raise to keep up with it. But that is one way of stopping inflation before it really becomes embedded in the U.S. consciousness.
Nicole, I'm really glad you brought up organized labor, because I think in the 1970s, when organized labor was much stronger, including in the private sector, that was a time when we did have persistent inflation, because we did have a wage price spiral, and you had a punching match between companies on the one hand and organized labor on the other. Each one would raise the price and the other would counter, but the prices go up, labor asks for more, then prices go up even higher. And some people have actually said that one reason they don't expect high inflation to become embedded this time around is that labor is much weaker. Now, you're an expert on New York City, and especially public finances, so you're looking at a particular part of the labor force that is highly unionized, public sector in New York City, but that's quite an exception to the rule. Private sector unionization rates, you might know the number, down like 10% or something, a tiny fraction of what they had been in the past. So people are saying that labor is not going to have power to demand full compensation for the higher prices, because the workers, the employers have more control. Now, that's good in the sense that it breaks the wage price spiral. It's bad in the sense that workers end up getting the short end. You want to have any thoughts on that?
Yeah, I think you're right in that the public sector labor force has a much greater unionization rate than the private sector, much more powerful in terms of bargaining and so forth, and frankly, quite powerful. New York City right now is fairly weak in terms of, we've seen 300,000 people leave the city over the past 2 years, most of them higher earners, higher taxpayers. Where our unemployment rate is far higher than the unemployment rate in the rest of the nation. People haven't come back to work in person at their white collar jobs. So Midtown Manhattan, Lower Manhattan, still missing retail, restaurant, other jobs supported by white collar workers. So it's not the time to have a sanitation strike where the garbage isn't picked up. With crime rising, it's not the time to have a police work slowdown or anything, not the time for a teacher strike when the kids have missed a year and a half of in-person school. Learning is far behind because of those school outages. So the public sector, at least in the short term, has quite a lot of power in not even outright threatening a strike, but when we get into labor negotiations toward the end of the year, I think the city will do everything it can to avoid any hint of work stoppages or strikes. So there's some leverage for unionized public sector workers to gain wages to keep up with inflation. And now, as we've talked about, the people at the lower end of the wage spectrum have already gotten their raises over the two first pandemic years. So who is left that is in a weak position? I think it's really the non-unionized white collar workers. You know, as Bill was saying, investment bankers are paid too much. You look at the people who are highly paid in the tech sector, in the banking sector, in the legal sector, PR, marketing. So are we going to see a sort of equalization where unionized blue collar workers, non-unionized blue collar workers, they see their wages keep up with inflation, but the white collar side, the wages are slowly eroded because they have much less bargaining power in the workplace?
Yeah. Bill, any thoughts?
Yeah, I don't know. I don't know how this ends. I mean, if you look at you know, what happened in the late 70s, early 80s, you know, Paul Volcker had to raise interest rates to, you know, 15, 16, 17% or whatever. I mean, we're so far away from that, and people are already freaking out about interest rates that if that's what it's going to take, then there's going to be a lot of pain to come. I prefer to look at it as, you know, when are the capital markets going to function properly again? When are companies going to be able to issue debt and equity securities at rates they're comfortable with, and that investors feel like they're getting compensated properly for the risks they're taking? I mean, I know I sound like a broken record a little bit, but, you know, as I said, the bond market has been uninvestable for 10, 11, 12 years now. You know, until interest rates properly reflect the risks that investors are taking and they're getting rewarded to take, then the capital markets aren't going to function properly. Without the capital markets functioning properly, then capital does not get to the places it needs to get to, you know, to be put to work productively. And I think we're actually, I mean, if that's what it takes, I'm actually more optimistic. If it takes a Volcker-like central bank action, you know, raising interest rates to where they were in the late 70s, early 80s, we're in big trouble. If it takes, because, you know, real interest rates are nowhere near positive at the moment. If inflation is 9%, you know, so that would be, you know, how many basis points? 700 basis points of increases to get to real interest, positive real interest rates. That's going to be a huge mess. If, however, you know, what you see in, again, my favorite proxy, the high yield market, where interest rates are already zoomed from, you know, 4% to near 9% since last fall, then I find that to be extremely healthy. Although anybody who bought a junk bond yielding 4%, who should be no longer in their job as a fiduciary for anybody who's depending on their judgment, you know, is getting crucified, and rightly so, I might add. But now, you know, it's, you know, interest rates and treasuries and corporate debt and high yield debt are actually beginning to be kind of attractive looking. And so, you know, I think another few hundred basis points up, and, you know, you're going to see a lot of excitement in the bond market, and that's going to be good for the capital markets. That's going to be good for capital movement across the world, and that's going to get our economy out of the doldrums.
All right. Well, we haven't had any fresh questions in the Q&A, and we've covered a lot of ground here. So I think I'm going to wrap it very soon. I just want to tell Rhoda that she should have Bill come back on after he's done his documentary to tell us more about crypto.
Well,
Zach, what do you think, Rhoda?
I know Rhoda always loves to have me
I love having you, Bill.
early and
I love
often as
having all
possible.
three of you.
Thank you.
So
Thank
you're all
you.
going to come back, I'm sure, for another take on this. So is there anything you want to leave the audience with? Something optimistic? Any little roadmap? Something that you would like to impart before we do close?
I'll just say that I would advise people not to do anything rash. You know, prices of their stocks and bonds have fallen a lot, but you know, now's not the time to bail. If you're the kind of person who was counting on timing the market, then you've already failed, and it's too late to catch up now. So just sit tight. And that's not a financial. I shouldn't be giving financial advice because I'm definitely not qualified to do so. But I just find that buy and hold is for most people the right strategy over the long term.
And you know, I would second Peter's observation right there. Again, also seconding that it's not financial advice. I wasn't qualified ever to do that, despite an MBA and 17 years on Wall Street. I would just add, watch the bond market, watch the yields in the bond market. When the yield on a high yield bond gets to 10%, I think you're going to see this economy bounce back to something more rational that we would all, you know, a lot of air, a lot of heat, a lot of exuberance out, but something we all can sort of be comfortable with, because that's when capital will flow and get rewarded for the risks it's taking.
Yeah, I would echo those comments and just add that though it's very difficult to extract anything positive out of the past 2 years, it's not a bad thing that lower wage workers are earning more in the marketplace right now. We've been talking about inequality. You know, I remember a couple of years ago going to one of Rhoda's in-person events and talking about inequality. This is a modest mitigation of the inequality that has grown up over the past few decades. And so as Bill was talking about, misallocation of capital, some reallocation of financial resources to the people at the lower end of the wage spectrum is a healthy correction for the economy as well as the financial world.
Okay, I want to thank all of you. I love having you, as you know, and it was quite an evening. A lot of great information and a lot to process. So I want to thank you, Peter, and thank you, Bill, and thank you, Nicole, for a great job tonight. We'll talk again. And to the
Thank you, Rhoda, for having us.
Thank you,
Peter,
Rhoda.
Yeah.
great job, Peter. Thank you.
Thank you. Thank you.
And to the
Nice
audience,
talking.
yeah, and to the
Bye for
audience
now.
still with us, we will be sending you a survey about the program. And we hope you'll tune into our website for the programs that are coming up for each month this year. So thank you all for joining us. And thank you again, Peter, Bill, and Nicole. And good night.
Thank you. Good night.
Good night.
Nice.